To the Trader Merlin Show. It's your weekend edition. Friday it is. Happy hour, everybody. So cheers to all of you in the trading world out there. It's our watering hole, the end of a long week, and hopefully the beginning of a glorious weekend for all of you. A quick shout out to my friend Carrie, who actually bought me the drink of the day. This is a Rubicon. We got a Rubicon from up in the foothills of the Sierra Nevadas. There's a great little distillery there that he took me to a few years back called Dry Diggins. It's a small batch distillery. Makes absolutely delicious whiskey. Today we're going rye. It was a good week out there today for me. Finished today actually with some losing trades, which kind of is frustrating, but you know what? You can't win every day. And one of the worst things for me is losing on a Friday. I hate it. But all in all, it was a good week for me. So cheers to everybody. I hope you had a great week as well. That's delicious. All right, big shout out to everybody. Hello, Joe, Terry, Sam, Kev, Big Eb, Otto, Thomasina, Brendan as usual, and all the others that I have not given a shout out to. Today I'm going to do a lot of listener questions. Obviously, there's a lot of stuff I have not been able to get to. Again, thanks to all of you, and maybe podcasters as well, who have been putting your questions down below the videos on YouTube. I've been going through those, and I will be addressing many of those as we progress on today's show. So let me start off a little bit different. Normally what I do is I do the top 7 markets, and I do them for that day. I'm going to maybe change that for Friday and just here's kind of the week synopsis of where we stand for the week. So we'll do a market update, but a little bit different as we do it from a weekly perspective. So let's take a peek at your worst performer for the week, and that is crude oil. Yeah, not so good. I actually, I am carrying crude oil long into the weekend. I know it's a bit of a risk, but I am doing that. I do think you'll see some positive moves in the market actually next week. So I'm taking a flyer on this one. But on the week, you can see down 11.6% for crude oil. Not too good, and it's resting right on those lows. And what you're looking at here is the continuous contract. Obviously, when I trade, I'm not trading the continuous. I'm trading off of the next contract, which right now would be the CLM20. And here we'll bring that one up for you guys so you can see it. It's also just kind of teetering on those lows. For me, 25 was a nice buy point for crude oil, at least for kind of the next few days. We'll see how it pans out next week on Monday. But boy, you see we've got some nice unfilled gaps still. That $42 gap, I do think is going to be a closed gap here at some point, and that could bring up a lot of other oil companies as well. That was your worst performer by a good margin. Surprisingly, gold is your next worst performer for the week. GC is I'm going to bring up. Again, I'm using different futures products and ETF mixes here. You can see it's been a very wild ride, although it does look decisively bullish, even though for the week we were down 3.5% on gold. I still think you're looking at 1,800 gold here within the next couple months. I mean, it wouldn't surprise me. When this next leg down happens in the equity markets, you'll see gold spike back up as people go in for those, let's call them safer or tangible investments. What's next? Let's go to, I don't normally look at the Dow. Let's see if I actually get the YM on here. Bring up your YM. YM was up. I haven't put the numbers on the YM yet. You're looking at a 2.26% gain for the Dow for the week. Nothing noteworthy. You can see, one reason I like looking at these on a weekly basis, and I would encourage you all to do it, it gives you a sense of emotion and fear and greed. And you'll notice this week, even though we did have a couple wild swings, is really one of the smallest candles we've seen in the past 8 weeks, right? You'd have this one here the first week of April was rather small compared to these other guys. Obviously, nothing compared to what we're seeing back here in December of 2019. Yeah, I'm going to do better on YouTube. We're going to keep going, man. I'm hoping we do better and better on the show, and you guys have always been great from a support perspective. Brendan says he's going to see 2,700 gold. That's a lofty goal there. I'm not saying it can't happen, especially that would look, if we get to 2,700 on gold, let's go back to that chart for a second. Maybe we'll do a longer update to start here. If you go back to that GC, I'll just say TJ. TJ, can you go back to the gold chart? If you're looking at 2,700, you're basically looking at a systemic failure of fiat currency. And then I think what would happen is if we got anywhere near that, you would see regulators come in and all of a sudden now talk about, confiscating gold because people are moving to gold as opposed to actually holding fiat currency. So I don't see it happening, at least not in the next couple years. But if there is a systemic failure, we could easily challenge that 2,000 mark. But 2,700, I think, is a bit of a stretch. But hey, you never know. Markets are crazy beast. All right, so Dow was on that list. Let's go to Bitcoin. Bitcoin was surprisingly quiet this week. Here is your week for Bitcoin, up 2.41%. You do see some real wild swings, right? Back on April 12th, we had some wild swings, also on the 14th, but all in all, it really didn't do much. I mean, hearing 2.4% for Bitcoin, normally that's like a daily move. For the week, not too bad. All right, moving up the list, we're getting to major market indexes. We're going to go to the S&P 500, which is back on my other platform, which is on a different screen, and we'll go at ES. S&P 500 is what I'm looking at here, and for the week, let me go and just draft up the lines because I have not added those for you. I'm using TradeStation here right now. 3.25% is what you had for the S&P. All in all, not bad. It was certainly a choppy week. It finished very strong. For those that were watching the end, I had 3 contracts short this afternoon, and all of a sudden that move just started ripping up. I bailed out, took a little bit of a loss on that one, and I am with no S&P. Actually, I closed those out, and then right as we rolled over, I actually shorted another one. But so I have one short over the weekend. Let's look at this on a 5-minute basis so you guys can see what this looked like. Because that rally at the end was fantastic. I mean, it was really, really aggressive. You had from, let's see, that low there of 28.23, call it 28.24, all the way up to a high of 28.60. That's a pretty significant move in a rather short period of time. I think a lot of people feeling optimism for the weekend, and unfortunately, I do see this optimism. I do think people are going to, at some point, you're going to hear an announcement that says, hey, you know what? We are going to lift quarantines and we can start to get back to normal. When that happens, I think what you'll see is a big surge up in the equity markets as everyone's going, oh, finally we're out. And you'll probably see that happen for a couple of days or maybe even a week. And then I think the realization that it's not flipping the switch and things are back to normal right away. I can already tell you, there's people who aren't going to be going back to their jobs, even if their employers call them back, because they're already happier doing things in quarantine and living a different lifestyle than they were before. I'm raising my hand on that one out there. So there might be some disruption in this employment, and that could create disruption in the business. And of course, I'll show you the chart of the week here after we do our market update, which will shed some light on the severity of the situation that we are in. All right, so that was your S&P 500. That's not even your best performer. Best performer on the day is going to be your NQ, NASDAQ 100. And it's, again, because of those securities that are in it, the FANG stocks. Let's go to a .w for a weekly basis. You can see we've had a month of just really powerful moves. I'll show you the last week. The last week showed a gain of 7.1%. That's phenomenal, but look from the lows. The low here, you're up 32, call it 33% on the NASDAQ in 4 weeks. Amazing. Those are holding on to those shorts. They're getting crushed. And I think part of this is exactly that. It's going to be a short squeeze that ends up crushing a lot of those investors who are short, and then it will start to flip and go the other way. Big Ed said, never thought we'd see $18 a barrel in oil either. Yeah, you know what? This market is just full of surprises, isn't it? Crude oil at 18. Yeah, I didn't think so either, and it could continue to go lower, right? It could. And I guess this is where we have to define our style and our perspective on it, because yes, it could go lower. So in the interim, do you stay short because that's where the trend is and the pressure is? Or are you looking at it from the perspective, as I am, of this is an investment that's going to be a longer term thing, and if I look at it for the next even 6 months, I think we'll start to see it run back up, because we're not going to be in quarantine. As soon as we get out of quarantine, people are going to start moving again, consumption will go up, demand will go up, and we'll start to see that change a little bit. And I don't know if it'll be a dramatic one, but I think that'll be a shift in at least creating a floor for crude oil. Then you add in production cuts, which you're starting to hear about production cuts. Maybe those will increase because, as I've mentioned, Saudi Arabia and Russia and the U.S., they need higher oil prices, right? It's what they need from an economics perspective. So it's really shocking that we're down at these levels on crude oil, but I think you have to pick long term. Yeah, you're probably going to see them go a little bit higher. Cheers to crude oil. I've been putting some nice money in my pocket lately, I have to say. Crude oil has been wonderful. All right, so that was your number one. NASDAQ, as I mentioned, up 7% for the week. That's your market update there, your details on all the market. I know, we have a lot of fun this week going over those numbers as they change so drastically day to day. All right, I want to go to one other thing here before I go to listener questions and dive deeper into many of them, because there's some great ones. I've been doing the chart of the week. So let's start with the chart of the week here. Now, the last 2 weeks that I've done this, it has been the unemployment data. The unemployment numbers have just been crazy. And you're now looking in 1 month, 20 million people have filed initial unemployment claims. Again, all of this has ripple effects through the economy. It's all going to end up coming out in the earnings statements, not in Q1 as heavily as it will be in Q2. So what I want to do is show you this. The chart of the week is actually manufacturing. Now, I know for those of you who listen to Power Trading Radio in the past and you heard John O'Donnell's comments, manufacturing isn't the real driver of the economy. And while it may not be the driver, I think we'd all agree it's certainly a major component. It is a big component of it. So any real change there could create problems. Check out this chart of the week. Here is the Empire State Manufacturing Index. And for those that don't know exactly what the Empire State Manufacturing Index is, it's a collection of a bunch of different data. They basically go to about 200 different manufacturers in the Empire State or New York area, and they basically just give them a survey, and they talk about their sentiment on future activity, economic activity, spending, hiring, and investment, and a few other things. This is important, right? You need to have manufacturing. And what I wanted to, the reason why this one is the chart of the week is if you look back here into 2009 when we were in our financial crisis, right? The shit was hitting the fan, right? People were freaking out about the markets at that moment in time. Well, we were only down, I believe the number, I get the exact number, I think it was 34, negative 34. Remember, above the zero line means we are expanding as a manufacturing region of the country. Below it means we are contracting. Now, I know we all expected contraction to go on in our economy. Certainly, seeing these numbers drop wouldn't be a shocker to anybody. But we have far eclipsed, right? The lows we saw back in 2009 was only negative 34. We came out today at this week at negative 78. So right now, this reeks of pessimism. This reeks of very bad situation going on in the manufacturing area. And mind you, this is just for the last month. We have been in full quarantine for a month, and I think that this is going to continue to some extent. So we could see these numbers drop even more. Again, this turning on the switch, turning on the economy, it's not going to bounce right back in the next month and all of a sudden be positive again. This is going to have a ripple effect, which again is why I've been rather bearish for these markets for a bit, and I do think we're going to see another leg down here in our equity markets. So there you go. That is your chart of the week. The doom and gloom purveyor? I don't think I'm doom and gloom, but it's an ugly picture to be sure. Okay, yes, Joe, that's just for New York. There's also the Philadelphia, the Chicago. There's different regions of the country. But for some reason, and I don't know exactly why, but my mentors over the years that really got me into fundamental data and economic data pointed to the empire as being the dog that wags the tail, right? They're the bigger one. Is that true? I'm not 100% sure, but I always seem to see more emphasis put on the Empire State Manufacturing Index. So, inherently, I'm putting more emphasis on the Empire State Manufacturing Index. Okay. Brendan says this is what I call the largest sucker rally in history. You know, it's really interesting when we look at the way that things have been developing, right? You have been hearing more and more pundits become bearish. And that was, going back 2 weeks ago. Now what you're seeing is them all of a sudden becoming bullish. And that goes to some of our listener questions. So let me see if I can get these questions up here. There are a few of them, and a shout out to some of our viewers that sent these in. I really do appreciate you guys sending in all these comments and questions. This one is from Otto. Otto in South Africa. He can't watch live because he's got a different time zone, but thank you so much for listening down in South Africa. He says, I noticed that you were continuously bearish, big caps on bearish, on the S&P 500. On the daily chart, the downtrend line from all-time highs was broken, and a new uptrend line is being established. The markets will do what they do, and it isn't mere bias influencing your judgment. Great question. And to some extent, you're right. I am bucking the trend right now. I am still finding my best trades, and most of my money is being made on shorts on the S&P, but it's about timing and finding those supply zones and finding the right spot to go long or short. My trades or my talk track here sometimes, I guess, maybe gets convoluted with short-term or versus long-term investing or trading. In the intermediate term, the next 6 months to, let's say, next 6 months, yeah, I'm extremely bearish. I don't think I could be more bearish. The next, 3-4 years, I'm not that bearish. I think you'll probably see this market rally and come back up like it always does. It shows resiliency. We'll find a new normal and we'll get ourselves back on track and the market will move up. But for the next few months, we're in a world of hurt. We still have not emerged from this thing, and I think it's going to be dragging on. And I still think because of the lag time for it to hit the financials, the earnings, and the economic data, That's where the pain point comes in. So he says on the daily chart, I'm going to bring this one up because he's absolutely right. 100% right. Let's go to a .D so I can bring up the S&P 500. I'll just bring up the S&P futures. Let's go to, and he's drawing trend lines here. You could draw trend lines in a million different ways. I'm going to do them rather rough here. This is kind of in snap mode, so let me take off snap mode on this platform. It's a nice feature, but sometimes it gets annoying. So basically what he's saying is at some point, maybe in here, we broke that downtrend, right? I guess you guys could all see that recently we have seen this break move up. Probably on the 6th would be where you could say we officially broke this downtrend line on the S&P. So that begs the question, do you now all of a sudden go long? And I think that that's what's happening. A lot of people are doing just that, going long on that break. And now they're saying, here is your new trend line, which is intact. It's looking pretty nice, right? We're bouncing the upside. Yes, you could be making that argument that we are on an uptrend. And again, this would be very short term because I don't believe that we are out of the woods yet. And I do believe we're going to see this market take another leg down. Now, let me see if I can do this. I should have prepared these charts for you, everybody, but I did not. So let me see if I can get some of these charts up. Let me go longer term here. And we'll go out and look at 20 years because there's an eerie similarity between this and what we saw in 2007, 2008 chart-wise. So let's go back. I'll just put 20 years on this one. We'll keep it as a, let's go to .W so it's easier for me to scroll. And I want you guys to remember this picture that you're seeing right here. Just that aggressive sell-off and then an aggressive rally. And I'm going to go back to 2008 so you can see the similarities there. I don't know why it's not letting me get all the way back. Why won't you let me get back to 2008? I said I want 20 years. Format. Aha. That's why. All right, let's try that again. Let's go back 20 years. Right now I'm at 2013, 2008, and let's go a little bit further to 2009. So what you had in 2008 was aggressive sell-offs followed by aggressive rallies. Now, in scale perspective, it's still, I guess you can make the argument that this would be an equivalent. An aggressive sell-off, it started to rally. This is on a weekly basis, right? So if it was daily, I could probably show you an uptrend in here, but then it continued to sell off. So it's a question of what's more powerful. Is it that continuing uptrend or is it the continuing downtrend? And this is the challenge we all have to answer for ourselves. I do believe, and let me see if I can show you this on a daily, because the daily might look a little bit clear. Make sure I got 20 years in here. Not 2. We need 20 years. Could take a while to load the data up. But you see the sell-off here in 2020. Aggressive sell-off, small hop. Aggressive sell-off, big hop back up. And I think you'll see the next leg down. Now we go to 2008. It's going to take me a second to find this one. Now there were certainly more drifting down moves. Right? They're not as aggressive, but you had aggressive sell-offs. Market started to show an uptrend right here would be a good example where, okay, market's bottomed. And yeah, we did have an uptrend for a little while, right? We had an uptrend for 2 months. Then it slowly rolled over, broke down, and had an aggressive move down. I think that this is what we're setting up for. We're setting up for a market that is going to have a relief rally. I mean, how the hell could it not have a relief rally? We poured trillions and trillions of dollars into this market to help prop it up, to save everybody's butts. I think that they probably should have let it fail. You guys know my standpoint on it. I think they probably should let that one crash, let the market figure out its problems, and then we would recover even stronger. But I think that what we're doing with this QE and all this trillions of dollars pouring in is actually just making the situation much worse down the road. And someone mentioned in the comment yesterday, kicking the can down the road. Yes, yeah, it's kicking the pain point down the road. You keep injecting all this capital. Yeah, how can the markets not go up? John O'Donnell did a really good thing the other day on Power Trading Radio years back, where he was saying that the amount of money that you put in to get a certain reaction in the market just doesn't make sense anymore. It used to. You put in $1 trillion and you get a massive move in the market and it's responding well. Now you put in $7 trillion and well, it's responded, but not that great considering how much money they put in there. Oh yeah, I wanted to mention this one real quick. You're going to throw me off on a tangent here, but Brendan says, Merlin, those won't be the last stimulus packages. I have to say this, and I know that every one of you is probably more astute than the average investor, but if you have friends who have received stimulus checks and they're out there talking about going to buy a TV or some appliance or spend it on some stuff, stop them. Take that money and pay off a frickin' bill. Pay off a credit card debt, pay off a balance that you owe, pay off some loan, pay off something with that money. Do not go and buy shit with it. Don't buy a new... Walmart's ordering thousands of giant 75-inch TVs or 80-inch TVs for $1,200. Conveniently $1,200, the perfect amount for your check. Don't do it. I've had 5 friends ask me in the last week, what are you going to do with your check? First off, I don't get one. Second, if I had it, I would go down and pay any little piece of debt I had. Find some way to take that capital and make more money with it. One friend in particular, shout out to Chelsea, she's got a 16% credit card. And she's got some debt on it. I said, take that $1,200 and pay off that thing because you're losing money at 16%. Stop it. Oh, sorry. It's getting me on a soapbox because, man, people are just, I got free money. It's not free money. You're paying for it. It's coming out of next year's tax return. So stop. No checks for most of you guys. Good. And yeah, I agree with you, Brendan. I think we're probably going to get more stimulus checks. It's really frustrating. And here's all these people going, socialism's bad. We don't want socialism. Well, pot calling the kettle black, line 2. Hello, this is socialism. Here's your $1,200 check to help you out because you can't manage your finances. All right, sorry. Brendan, I'm sorry to hear that you're selling off your house to pay off your debt and deleverage. However, selling off your house while the markets are at elevated highs was probably a good thing. You're probably getting a lot more money. Then when these markets crash, you can buy back in at much lower prices. So I'm hoping that will work out for you. I will cut my expense about 40% and my liabilities and debt. Woo, wow. Hopefully you can get out from underneath that as soon as possible. What are you doing? Real estate, housing prices going down. All right, let me get to housing prices here. Let me get to these other questions that come through. So I got Otto's question out of the way on the S&P 500. And it's really a matter of perspective. Number 2, who do we get? Given the points that this is from Natalia on YouTube. So hello, Natalia. I think you're with us today. It says, given the points you discuss, with bonds, stocks, and even cash money market presenting such downward prospects and risk, what growth options are left for IRAs for 2020 to 2021? Are gold, TLT really what's going to save the day for every IRA? Well, we can never make a blanket statement like this is what's going to help every IRA, right? Everyone's going to be allocated or positioned differently. So it's challenging to make a statement and say this is going to be the saving instrument. If you have the mindset, and again, I feel bad sometimes because I don't want to sway anybody's opinion out there. This is just my opinion. I know that some of you guys feel like you're bullish on the market, and that's great. I honestly, I don't care if your opinion conflicts with mine. Your opinion needs to be yours, but it also has to be wrapped around rules. So let's say, Natalia, for example, if you felt that these markets were headed for downward movements and a correction and more selling, then yeah, you have to go look for those inverse relationship asset classes like TLT or GLD. I'm a little concerned with TLT just because the bond market is so crazy and hazardous. Like, I'll bring up a chart here and show you TLT. Now, this is the 10-year treasuries. Look at those swings. You should not have swings like this in bond products. I mean, these are pretty wild swings. So bonds are meant to be a safe haven that give you a predetermined stream of income, right? Payments, you want to have stable income. While they may do that, this is the problem with it now, is it's giving that inflated risk where things are just moving all over the place. So to answer that question, which is what are the growth options for IRAs? I would say that probably the best growth option, I know this is going to sound really weird, the best growth option if you were bearish on the market for your IRA or your 401k is to go to cash. Just put it into cash. I know that you guys have been saying recently in the chat, cash is trash. Long term, we're talking decades, yeah, cash is trash. It will do nothing but lose value because your Fed, my Fed, if you're in America, or even Brendan who's in Canada, governments are just printing money like crazy. It's diluting fiat currencies around the world. Doesn't matter which one it is. The U.S. is just particularly aggressive in their printing. So long term, yeah, cash is trash. But if you said cash is trash for 6 months, I would disagree with you. It's probably one of the safer places to be because you're not going to see that hyperinflation in 6 months. For an IRA, for a 401k, from an investment perspective, if you had the idea and the justification that said, hey, these markets are going to go down more, then simply get out. Move to the sidelines, go to cash, and be happy that while your account is staying here and maybe getting 0.01% interest because it's in a money market fund, be happy with that because the market's dropped 20 or 30 or 40 or 50% from that point. What's great about being in cash is you have the flexibility to buy back in at any moment. So let's say you went to cash and the market dropped 10%. Well, if you bought back in 10% lower, you've already made a 10% rate of return. Why? Because at some point the market will come back up and you have now saved yourself 10%, if that makes sense. So to me, it would be the easiest thing to do, and the reason that I think cash is probably the best alternative is because it is so liquid. It's easy to just flip and buy something. And I know you could go into gold or other assets like that, even cryptos, but there is delays there. There are transactional issues. There are transactional fees. It could be costly. So I would say cash is probably the safest thing. If you wanted to be in the market and capitalize when it's sold off, or excuse me, if it continued to sell off, then you might want to look at things like GLD, TLT, and you could also go with some of the inverse ETFs, like SH would be an inverse of the S&P 500. What I would recommend, though, is do not get involved with the triples in your long-term accounts. There's a decay factor there that would take a toll on your return on investment, and I think it's just too risky in an IRA or retirement account to make those types of aggressive moves. Your IRA and stuff should be rather safe investments. Let's see. I'm missing questions. Brent sold our property with our first trust. All right, cool. To see Karen's. Where's Karen? I'm trying to read over these questions here, and I need a bigger scroll page. Maybe I need to like establish my monitor sideways. So Natalia, that's what I would say. I would say go to cash. It's just the safest place to be, and it gives you peace of mind. And the thing that sucks about going to cash is the market goes up 2%. You're like, oh gosh, I missed it. But then it drops 5%. And you're going, oh gosh, good, I'm out of it. Stay out. I think it's the safest place to go. All right, next question. This is from Philip on YouTube as well. He says, what are your views on investing in silver now that the ratio of gold to silver is at historical highs? That's one thing I don't look at. I don't really look at the gold to silver ratio. What I do look at is just the prices of commodities. We could go to, let's just do the ETF so it's going to be easier. We could bring up SLV. Now, interestingly enough, SLV took a pretty big hit during this market correction. I'm bullish on commodities. I'm bullish on silver. I'm bullish on gold. Now, I'm going to do two things here. And this is kind of how I base my investments when I'm looking at silver or gold, is purely performance. And I will show you from the peak where we started to sell off to the bottom here, silver had dropped 38%. And since then, it's rallied from that peak to where we are right now. It's rallied 30% again. So we dropped 38% and we rallied 30%. Now, let's look at GLD, for example, and get an idea as to how gold has performed. You can see here clearly a different story. Right? Gold sold off to the tune of 14.5%, but has really been kicking ass. I mean, this thing has just been dominant to where we closed at today. You're looking at a rally of 16%. So the percentage swings have been greater with silver. I still prefer gold. I don't know why. It's just old school, I guess. I think that they're both good investments. But the percentage moves tend to be greater with silver, and I guess that might be due to its lower price point and the more volatile swings. But I am bullish on gold. I'm bullish on silver. I don't really mess with platinum or palladium. I just stick to those two. I know some others will probably weigh in here in the chat with regards to that, because I know some of these guys are into gold and platinum and silver and palladium and nickel and in the case of Brendan, uranium, right? But I think commodities will have their day in the sun here, especially because of the uncertainty facing this market. And, you know, I wish I could tell you guys exactly what's going to happen in the next 6 months or year. I have no idea. I would love to know, because obviously that would make us trillions of dollars personally. But the market's just going to do what it's going to do, and hopefully we are agile enough and flexible enough to accommodate whatever it throws at us. I agree with Brendan. He says platinum and palladium are not true precious metals in my opinion. Yeah, they're more commodity metals from the perspective of utility, whereas gold is that ultimate store of value, and you know that's the historical value that it's had. So, yep. Karen says, doesn't it seem like gold and silver are being manipulated during these strange times? How about I reverse this question? Name a period of time where gold and silver have not been manipulated. I would make the argument that everything is manipulated, and I'm the ultimate skeptic out there. I think it's all being manipulated. I think it's pretty scary, but yeah, I think gold and silver are being manipulated. However, there's also real truth to buying those investment vehicles, and when we have a market that has so much uncertainty, historically gold's the safe haven, and that to me will continue to reign true. Brendan says, I think the cost of food will go up too, 100%. So this could lead to that hyperinflation aspect that we're seeing, because a lot of food manufacturing plants are shutting down. Demand may have, I think demand may have subsided a little bit, because now a lot of people are maybe eating less, not eating out at restaurants as much. They're finishing their plates as opposed to eating half their meals and throwing it away. But I'm hearing a lot about different. I think Smithfield just shut down a couple of their bacon plants or pork plants, excuse me. And there's going to be more and more of that, and we could end up seeing food prices start to rise really quickly, which I would go right back to the inflation argument. Shinja says, this is not 2007-8 today. 50% of homes have more than 50% of equity in them. It's totally different story than 2008. Yes, it is totally different story. I don't think we've seen the run, or let's just say the blatant stupidity by people taking out mortgage after refi, and then taking that money and going and buying new Escalades and diamond rings and things that they just really didn't need. I don't think we have that rampant of a problem with it. However, I do think that you have a market right now that you're going to see people try to take profits, and it's just like selling something after a long rally in price. I've noticed within the past couple of weeks a lot of for sale signs in my neighborhood. There has not been one for sale sign in my neighborhood in years. All of a sudden, boop, they popped up. So you have all these people now going to try to sell right at the same time. That could start to depress the market, because, again, going back to the lending process, you need to have an income to qualify for these loans. JP Morgan last week, which is Chase, who's a huge underwriter of loans, they did what? They basically said, you know what? We're going to raise our credit score. I think it was 700 or 720. They're going to raise the credit score limit that you have to qualify for a loan, and you have to put 20% down. Before that, that wasn't the case, which made it much easier prior to these days for people to get loans. Now they're making it more difficult, and we have 20 million people just lost their jobs. So it's going to be harder for people to buy those homes, and it's going to be more difficult for those people to sell the homes, because the buyers are slowly drying up and becoming more cautious. So that inherently could cause real estate prices to drop. That's the argument I'm making. Merlin, in regards to commodities, what do you think about DBC ETF? I think it's actually all right. The reason I like it is simply because you can buy, with DBC, you're buying a basket of securities. And I think that's probably, I'm bringing up the chart over here. Sorry, I'm typing symbols and I see it, but I haven't shared that screen with you because I'm the one who does the driving now on this show. Sheena Realtor says it's unreasonable to take profits in this huge U.S. inflation that's coming. Yep, it is, but a lot of people are saying, I want to lock in these profits because they have huge gains. Lock in. I almost did. I was really, really close, but I just love my home. I was going to sell my home, lock in massive. I'm a well over 100% gains in my property that I bought. I bought in March of 2009. Talk about being at the right place at the right time. I was lucky. But why not sell it now? Lock in a ton of profits, even pay the, I'm not even do a 1031, so pay the capital gains on it, and then just have it in cash, keep that invested, and then when the market does drop, because I think we'd all agree at 10, 20% correction housing prices would not be unreasonable. It's, do we see anything greater than that, the 30, 40, 50% drops? Then come back in and buy at much lower prices. That would be my plan, but I decided to keep my house out there. You like that, Gretchen? I figured a nice little festive Hawaiian shirt with a little bit of rye whiskey would do my Friday well. Hopefully you're doing well as well. I use well 5 times in that sentence. That's really well. All right, let's see. I was going down a road, down a listener question here, so let me make sure I get to that one because I got sidetracked. Okay, DBC. So I had the chart for you. There's your full left so you guys can see DBC. And it doesn't look like it's anything that amazing, right? It's not. It has been absolutely crushed recently. Oops. Let me get that out of your way. The reason that I think DBC is nice is because it gives you exposure to a wide variety of commodities. And why not, if you felt the commodities were going to be the piece doing really well, why not go in there and look for that as a piece for your portfolio? And this could also be something that, the question earlier from Natalia asking about TLT and GLD. Well, maybe you could, instead of just buying gold, you would buy something that's a little more broad and diversified, which would be, DBC. I'm actually trying to pull up right now, for some reason, my internet. I got this fiber optic and it was awesome, and it just, it's really slow. Oh, the beauties of it. Because I was going to bring up the components of DBC for you, because it's fairly diverse, if I remember correctly. There we go, DBC. Now I'll bring up the Invesco Deutsche Bank Commodity Index. Gotta love the Deutsche Bank one. And we'll look at the profile here in holdings. And it doesn't say specifically. Okay, here you go. So here's kind of what you be buying with that. Now, when you say DBC, remember a lot of it's going to be oil. But you do have other things in there. Right now, 50% of it's treasuries, which is kind of interesting. I think that's just their cash portion. You have U.S. Treasury bills. So basically 25% of this is treasury notes. That's security for you. You also have 5% gold. You got TC. You have multiple crude oils here. You got Brent. You've got crude oil for Feb 21st. ULSD. You've got RBOB. You've got wheat, copper, soybeans. So you do have a diversified mix of investments if you're looking at DBC. The fee for it, let's see, I don't remember the fees. I'll click on profile here so you can see what the fee structure is. Sometimes these get pretty pricey. Even pays a yield of 2.25%. That's pretty nice. And asset turnover, expense ratio. So you've got it's a fairly high fee of 0.85, considering you can go with an ETF like SPY, and it's going to be what I think is 0.09. It's almost insignificant. All right, cool. So that was that question. Now let me go to some more questions. I think I'm way past time, but I'm just going to keep on rolling. Philippe sent in that last question, so I will go to, how about this one? Yes, I wanted to get to this guy. Here is your next question. From Darren. I think Darren sent this one in on either Gmail or on the YouTube channel. And to answer Mike's question, it says, where were you supposed to put your comments to help with YouTube? Underneath the video, when the video is posted, there's a comment section down below that I guess helps with search engine ranking, so that would be helpful to me, and I know you guys have been amazing at helping, and the likes and subscribes that you guys are all doing helps as well. So Darren says, what's your view on the airline bailout today? Invest in airlines after Q2 earnings or sooner? That's a great question. I am nervous about investing in airlines right now. I think that when we do flip the switch, we can now get out of our houses. I don't see us all clamoring to go travel on an airplane. Certainly getting out and maybe going to the beach or the mountains or something, getting away out of our homes and visiting relatives, etc., might be a good option. But airlines are a different ballgame. Now, here's the deal. If you guys remember, I think earlier in the week I talked about it, you have a provision for part of the bailout is $25 billion for the airline companies. And of course, the big benefactors here will be Delta, United Airlines, JetBlue, Southwest, I think it's an American as well. A lot of those are very, very depressed. And by the way, for those who are asking, I did have my United Airlines puts. I think I told you guys I sold puts on United Airlines at 25. That was a 19.5% rate of return in 30 days on UAL, which I'll bring up here just so you guys can see that one. And basically what I was telling myself was I am okay to own airline stocks, but just at 25 bucks. This pattern that you're seeing form on United is not very bullish. It's actually a bearish formation, so I'm not overly optimistic on this one. But I think, Darren, you got to kind of put your pessimism hat on here a little bit. A lot of people are looking at this going, really, since the main news hit, which was in February, about the coronavirus being such an issue, United Airlines fell as much as 78%. Right now, it's down about 65%. And that may seem like a screaming deal. But remember, a lot of these airline companies, what they did is they took money that they got from these tax repatriation of capital and their tax savings, and what do? They bought their own shares. They artificially inflated the value of their share prices. So they're unfortunately suffering through some of that because their capital has been tied up in their shares. Part of the deal here is they're getting bailouts, but it's not really like a traditional bailout. It's not that much money. Now, the bailouts worked well for the banking companies back in 2008 and 9. Right? You saw Citigroup and Bank of America get some pretty nice chunks of change, as well as Goldman Sachs. Airlines, I don't think are going to get anywhere near as much money. And I don't think it's going to be as impactful yet. I would wait and see. Investing in airlines now or Q2? I would probably say Q2. What I would be doing right now, if you wanted to own airlines, I would be selling puts. I would sell puts right now, maybe do them on a weekly basis just to get some income going in, or do them on a monthly basis just to get that kind of payment coming in. And find a price where you'd say, what price would I be happy owning United Airlines at? And I'll bring up this on a weekly so we can maybe see a different perspective for United Airlines. I mean, United is at lows it hasn't seen in, it's been 8 years. Could we, is this a weekly? Let's go monthly. Monthly to see a bigger picture. Look at those lows we saw in 2009. I mean, United Airlines was at $3. Now, we are coming right into an area where most would probably say, hey, you know what? This is probably a decent buy point for it, right around this $19, $17, $18 mark. Yeah, that could be a buy point. But what about, you know, selling puts lower than that? Maybe selling puts at $12, or even selling puts at this $18 mark. You could sell puts at 18 and collect premium. Let me see if I think the option chain is going to be down right now, but let me see if I can bring this one up for you guys so you can see the options chain. And it's going to be a little, the spreads are going to be wide on this if I even get an options chain because the market's closed, but it'll give you an idea of what we can do. So bear with me as I try to bring this option chain up for you. That's funny, it just disappeared. There it is. Okay, so let me go here and yeah, it's shut down. I can't get anything on it. Not gonna work. Bummer. UAL. And again, you can pick any of the airlines. I think they're all. So let's say right now, today expired the April 17th. Those all expired worthless, and I got my $8,000. You could go out to. What do you guys want to do? Do you want to do a weekly or do you want to do a monthly? As an example here. What do you guys want to do? You tell me. Jay Rob says, I wish I knew how to trade options. It's not that hard, my friend. It's actually not that hard. I'll do both. I mean, I got time. I got nothing to do. I ain't got no job. This is my job that doesn't pay. So if I went out next week, so let's say we wanted to sell them for next week, okay? And right now, let me go out and set some more strike prices here. It says 8 strike prices. We'll go 20, so I can go out of the money. Like, who cares? Right now, United Airlines is trading at $29. So let's say I wanted to sell 18s, well, let's do 20s because it's on the screen. You wouldn't even, next week, no one's even willing to buy. Yeah, they're out there. So you wouldn't get paid much. If you sold puts, you might get 17. And again, this is going to be different because the market's closed, so these aren't going to be very active. No, yeah, you can see that's funny. So here's my position right up here. You can see it right there. This line right here is the trade I had open and expired worthless today. That's great. I sold them for $4 a piece and covered them at 0. Love it. All right, enough bragging. So you could go out here and say, all right, by next Friday, right? Next Friday, I will sell the $24 puts. That means you're committing yourself to buy at $24. Now, depending on what price you sold it at, right now the bid price is 40 cents. The ask price is 56. So you could probably get somewhere in between that. For that, let's say you got 50 cents. Well, for every contract, you'd be getting yourself $500. So if you save 50 cents, you would essentially be buying at $23.50. It's not that high of a premium right now. But if we go out to, let's say, the May 20th and go out 30 days, now you start to get a little bit more. So the $20 puts, you were getting 13 cents. The odds are it's not going to get there, so you're still going to make your $130 per contract. If you look at this, you're looking at 79 cents. So you give 30 days, and you could potentially get yourself, let's call it 80 cents. So it's $800 per contract. That's not bad. I mean, it's really far out of the money. It's $8 away. I mean, that means that United Airlines have to fall another, 20, more than that. $8 out from 29 to, yeah, you're like 40%. You have to fall another 40%. So these are all the different prices that you would get. If you thought that there's no way it's going to go to 27 by next Friday, or next month, you could sell the 27s here and collect $2.82 per options contract. That's $2,820 per options contract. So essentially, if you were exercised, you would be owning United Airlines at $24.18. If that makes any sense. So anyway, that's how I would do it, Darren. I would not be looking at buying them outright. I'd be using the power of leverage, the power of options to hopefully generate some income there. I'd use I would be selling options at a price that I'd be willing to buy it. Now, if you just absolutely have to have it, sure, you could buy it right now. But I don't think there's a need to do that. Brendan says, make sure you get. Oh, hold on. What would you call this strategy, Merlin? Put spread? No, just selling puts. I'm not spreading anything. I'm just selling puts. I'm kind of stupid when it comes to that stuff, guys. I'm not a spread trader. I'm just directional. If I want to own something, I'm either going to buy a call or I'm going to sell a put if I think it's going to go up. If I am bearish on something, I'm going to sell a put or I'm going to buy a put or sell a call. I'm going to do it backwards. And that's pretty much it. I try to keep it as simple as possible. So it's finding supply and demand zones and saying, where do I feel comfortable buying or selling this thing? Livia, I use TradeStation. I also have Interactive Brokers and E-Trade, but I don't really use much on E-Trade. I mean, I have like 8 different accounts, but most of my option stuff has been done on TradeStation. I should probably do a Thinkorswim. Everybody raves about it. All right, what other questions do we have there? It was 34%, Kev. Thanks. My math skills weren't on point there. Yeah, Big Eb, credit spreads, debit and credit spreads work well. And, that's why I love bringing on different traders to this show, because everybody has their own way of doing things. For example, you look at Steve Moses. You look at Tim Blotzer. Right, these guys are spread traders, and they're basically, he said, I'd rather make slow nickels or fast nickels than slow dimes, and he's basically doing short-term spread trades. And why not? It's working. It's a way for him to generate small rates of return, but to do it consistently. Whereas if you're directional, like I tend to be more directional, I'm going to have some moments where I have some colossal grand slam types of winners, like I did at the beginning of the year with my puts on the S&P. But I also have moments where I'm sitting underwater on something that may expire worthless, right? And I could lose my total investment for that options contract. But it's just a matter of personal preference and what we like to do. I like to keep things as simple as possible. Kipton was very interesting when we had him on the program on Monday. If you guys didn't get a chance, check out Kipton Carriaga. It was really interesting to see how he is using options, selling off delta and things like that. It was interesting, but that's a rather complex strategy. I'm looking to get more options traders in the program. You guys have been asking me about a few different things, which I'm going to try to get these guests on the program here in the near future. All right, what time have I got? I'm certainly not going to go past an hour on today's show, so let me see if I can... and I got one more. Okay, Joe, who's with us in the audience today. Joe, I got to one of your questions. It was definitely on the list. He says, Goldman Sachs reversed its bullish outlook and now states that there is a high probability that the bottom in the equity markets has been set with the March 23rd lows. Technically speaking, what will signify the bottom for you in the equity markets? Well, there isn't I don't have like a numerical metric. There's no definitive rule. I say, well, if this happens and this happens with this, then it's bottom. Right now, Goldman has every right and every reason to make that statement, because when we look at the chart of the S&P 500, and I'll bring up your ES again, it qualifies, and go to dot daily, it qualifies as a bottom, right? The only thing that we don't know is its time. Because yes, this is a bottom, but is it the bottom? I think that's the difference here. I don't believe that is the bottom. I believe this is a bottom. I believe this is an aggressive dead cat bounce. Someone said earlier, a dead hippo bounce. I think you could see these things just, continue. It could go higher. Could we see it go all the way up to 3,100? Sure. But let me ask you this. And I know you guys many of you are the same viewpoint as me, but if we got all the way up to 3,100, right, which to me is like the next massive area where I would say it's going to have some significant difficulty going down. If we got to 3,100, we would only be, what percentage off the highs, Merlin? You're doing the numbers today? We would only be 8% off the highs. Do you think that with all this crap that's going on, with unemployment numbers through the roof, manufacturing numbers plummeting, retail sales numbers, looking like Britney Spears' music career, these numbers are not worthy of a market that's only down 8%. And I know what people are thinking. They're washed up in all of the support, bailouts, funding, all that money press printing. Yeah, that's fine and dandy. You can do all you want. But the numbers are so appallingly bad that to be down only 8%, that would represent a point for me where I would really be heavily shorting more and more. And I'd take a lot of risk on that one. Just because it doesn't make sense that this market should only be down as much as it is. Right now, if you look at this S&P 500, and maybe if anybody disagrees with me, please comment. I'd love to hear conflicting arguments. We're only down 15%. We haven't been able to leave our homes for 30 days. 30 days. No sporting events, no musics, no concerts. There's no way we only be down 15% right now. We should be down much, much more than this. So yes, the support the Fed and the government's been giving us is propping up hopium, but it's a big bowl of hopium, and people are smoking on it right now. It's gonna give up the ghost, so to speak, and we are going to see another leg down. So, yes, Joe, what signifies a bottom? This is a bottom, but is it the bottom? That's the question that I have. I don't believe it is. I think this is just a bottom. We get many bottoms, and it's always a bottom until there's a new bottom put in. I know it sounds so vague and ambiguous, like I'm skirting the question, but I think you would all agree it is a fact. A bottom is only there until a new bottom is put in, right? So I'm not trying to skirt the question, but clearly from a technical perspective, that is a bottom. Yes. And Goldman is right on with their comments. Goldman is notorious, absolutely notorious at being late. I forgot what it was. I think it was copper a couple years ago. And copper had already dropped like 60%. And Goldman says, well, we're looking for a decline in copper. It's like, it already dropped 60%. You're telling me this now? It's like watching the train having left the station, and you can barely see it anymore. You can barely hear it. And they're going, now departing on track 3, the train to nowhere. Thanks, Goldman. Because Goldman and JP Morgan and Wall Street are going to use us, retail investors, to do their bidding. When Goldman comes out with an announcement and says, this is the market bottom, the sheeple, all of the novice people who are watching Jim Cramer, and that's all they watch is CNBC, are out there going, bah, bah, and they go out there and they buy because Goldman says this is the bottom. It's an opportunity for Goldman and other institutions to sell the shit out of the market because they can, because they found a patsy. It's the way the markets work. It's the way they've always worked, and it's the way they always will work. So when you see that Goldman says something like, oh, we're now bullish on the markets, I'm instantly looking at going the opposite direction. I'm not saying I'm going to do it blindly. I have to have a plan in place, but I certainly don't want to get caught up in their rhetoric, which is to drive people to investments that benefit their firm. Why did Goldman Sachs beat earnings this week? Big bond market sales, right? They're manipulating things. They're using the media. They're using press releases to steer the markets in their direction. Daniel, that's good. I am one of those few people who knows when the real bottom is. 2 years after it happens. Thank you for the humor. Yeah, I mean, sometimes we just don't know. And this is one of the interesting things. And if you look at some of the XLT sessions that were done at Online Trading Academy, we were... More whiskey. Sorry, Big Ab. Was I going on a rant? I apologize. When you look at the big picture here... Sorry, Jack. I went on a little rant. You just have to understand that the institutions, the markets are they're the ones driving prices. And the retail investor is caught up. I mean, I know so many people that during this market correction, what do they do? My phone is blowing up. I'm like, hey, what should I do right now? I don't want to be your financial advisor. I do not have any interest in being anybody's financial advisor. I'll tell you what I think about the markets, and you can formulate your own plan. But Goldman is trying to sell shares. I'll go back to a story. Damn you, Big Eb. We're going to get a 1 hour show today. Son of a... I think I told you this story. When I was in college, I was the president of the financial management organization. I don't know, it was just a way for me to meet friends. So I joined this club, and then I became the president of it. And we went out and we were... I asked people, find people in the industry. We had brokers, we had market makers, we had CFOs on, and they would come into our classroom and give a presentation about what jobs are out there for us. Because I got a finance degree and I don't really know what I'm going to do, so share some ideas. And this guy walks in. He was a Bank of America broker for equities and stock market stuff. And basically, he come in and he's like, throws his keys on the desk, and I notice right away he's got a Ferrari keychain. And of course, my eyes are like, ooh, Ferrari, right? I'm in college. I'm paying down debt. You got a Ferrari. That's what I want. He's got his Armani suits on and Prada shoes, and he's just dripping and oozing money. Well, pretentiousness, really. But anyway, he was just dripping money. And he starts his presentation about, he goes, guys, I'm a broker for Bank of America, and I make so much money, I don't even know what to do with it all. And of course, we were all looking at each other like, hell yeah, this is what I'm talking about. What are we doing? And basically what he told us in a nutshell, and I'll try to keep it short, is he says, I'll come into the trading room in the morning, right? I get there like 5 o'clock in the morning, and our trade desk will come in, and the trade desk manager will sit down and give us each a piece of paper. And on that piece of paper, it will tell you your talk track. So, for example, let's say it'll have, buy or sell. So if it was sell, these are things that the firm is trying to sell. as you would read down there, it'd say Dell Computers. At the time, you used Dell as an example. It said, Dell Computers. We think that you guys should be buying Dell because of, and all these amazingly sounding, perfect institutional scripts on why you should sell everything and buy shares of Dell from me, your broker. The reality was, the Bank of America firm was looking to sell their shares of Dell. So they're going directly to their clients and selling something that they own. They literally created a buyer by calling their client books. And I went, well, isn't this a little bit conflict of interest? He goes, oh, not really. I mean, we're telling them what to buy, and it's a good investment. I'm like, yeah, but you're telling them, you're selling it to them. That's the problem. To make it even worse, he would say that on the page there were little marks, and certain, like a palm tree would mean if you sold X amount of shares of this one stock, you would get a trip to Hawaii. So of course he's going to look at that list and go, oh, well, Dell's got the palm tree. I'm going to Hawaii. Boom. And he did nothing but push Dell all day. It really gave me a sour taste for brokers, and I know that there might be some brokers watching this right now, and they're thinking, I hate you, Merlin, with all my heart. Not all brokers are like this. This was obviously way back. This was 20 years ago. But I'm sure that there's some residual practices that are still done to that extent. Clients of major firms like Goldman, like JP Morgan, are out there to make money. If you make money in the process, that's great, but it's more important that they make money. So Goldman saying this type of stuff, just be careful, think the opposite direction, but don't go short just because Goldman says the bottom is in, right? It doesn't mean we have to turn, but it should put your alert system on, your radar should go up and be like, you know what? I'm a little bit skeptical about this. I know, Big Eb. It is the brutal truth. And this completely changed. Because I saw that, it changed my whole perspective. I actually went from there, and I was working for a financial planning firm. And I realized the financial planning firm is rather similar, right? They get paid by mutual fund firms to promote certain mutual fund products. So if I have let's say I'm managing all of your money. If I'm managing all of your money, I'm doing everything I can to save you on costs and put you in the best investments that's going to achieve the goals that you've established for me that you hope to achieve. But one of the interesting things that we don't know behind the scenes, the Wizard of Oz, if you will, is that many of these financial advisors, they are approached, just like a doctor is approached by drug companies, to promote a specific fund family. So I've got two mutual funds I could sell you. One would be, let's say, SPY, the ETF, with 0.09% fee. Or I could sell you the Merlin Rothfeld Equity Index Fund. Sounds great, got a great track record, but the fee's like 5%. I would, in my heart, as your advisor, I would get you SPY. I'm saving you money. A lot of financial advisors are going to go with what makes them money, and they will get kickbacks for me selling you that 5% mutual fund. That's the shady truth of the industry, and unfortunately, it's just the way it is, which is why I love doing what I do. And it actually made me go down and take a class with Online Trading Academy back in 1998. Not to sound like a salesperson, but I realized there had to be a better way. When I saw direct access, that just changed my world forever. It's like, I'm going to cut out all these people that are all trying to make money off my trades and investments. Sorry, guys. Did I go off? Oh, well, that one, yeah. Harrison, that's a good analogy. They're like strippers finagling thousands from the drunk customers. They're making you feel like you're so special. Oh, you're the one, sweetheart. Let me pinch your cheek. Hi, baby. Want to dance? No. All right. I got to stop. I got to stop my rant. I got 2 minutes left to keep this under an hour. Big Eb, this is all your fault. All right. Let me see. I had one thing I wanted to show you guys here before we end the day. I will wrap it up because this is by far the longest that we've done a show. If you guys like my rant, please give me a little thumbs up there. Yeah. If there's fee only, alas, Merlin is correct for every financial advisor except fee only advisor. You mean if you pay them a flat fee? Maybe. It's still the assets that are in there, and think 401ks are no different, right? Your fund that makes your 401k, a lot of times those aren't the best investment vehicles. I've noticed recently they have been much better, but there still are mutual funds in a 401k that are higher than they should be. But anyway, we can keep going on. Cool. Crypto donations. I haven't reached that point for donations yet, but I appreciate the thought there, Brendan. 60 seconds to go, Harrison. All right, I'll wrap it up. Anyway, I hope you guys enjoyed today's show. I have one other thing to show you here. We talked about the manufacturing sales. I want to show you what's happening on Monday. So here is your Monday's earnings calendar. There's not a lot to speak of on Monday, right? So I don't think we need to be too crazy on Monday's trading activity. I don't think you'll see too much volatility. You see, you got Halliburton, Ally Financial, Infosys. What's another big one in here? I'm going by market cap. So you've got Steel Dynamics, Equifax. Those are some of the major ones. Really, it's about later in the week. You have IBM on Tuesday. You've got Netflix, Lockheed Martin, Coca-Cola. I believe you have Philip Morris, Amazon, and Intel. So those are some of the major ones for next week. The question came up from Darren about airlines. I think it was Darren about airlines. Next week, we have 2 airlines reporting. I believe you have United Airlines and American, if I'm not mistaken. So be careful out there. That could add another leg to their volatility. And honestly, I don't know which way that could go. You could see huge volatility swings. And again, as an option seller, that may actually give you some extra premium out there. Whew. Cool. Big F's special ever. Thanks, Gary. Yeah, well, sometimes I just tend to ramble, and I wish I could be more in tune with the conversation. Arvin, I'm not going another hour. I'm ready for another cocktail, but I'm not ready for another hour. All right, well, again, hope you guys enjoyed that. No guest on Monday. I actually talked to Bill Addis, who I had on the program this week, and he has some pretty big announcements, too. And he showed me a couple charts today. I'm like, dude, I don't want to be like the guy asking you to come on every week, but I'm going to have Bill Addis on again next week because he's got 2 charts to show you and also an extremely interesting investment opportunity based off the markets. Very interesting to look at some of the credit markets and where is there opportunity out there. Something I normally don't look at, but when I have somebody like Bill on there, and he's like, I've almost never seen this. So I'm going to bring him on. I believe we're going to have him on Wednesday, and I'll probably have a couple guests on next week. So again, thank you guys so much. Yeah, you love the 1 hour show more and more and more. I do too. I enjoy it. It's just I'm running out of content. No, I'm kidding. I could talk about this stuff until I'm blue in the face. All right, well, that will do it for today. You guys got your earnings calendar for Monday. Nothing too exciting. Macroeconomic calendar is not great. I'll get you more info on that. Again, if you like the show, give me a thumbs up out there. Share the show. Share the podcast if you can. Tell people just go to TraderMerlin on iTunes or on YouTube. Subscribe, support us. That will do it for today, everybody. Until then, have a fantastic weekend. Cheers to all of you. I hope you have a great weekend. I'll see you on Monday. Take care.